The headlines are lying to you. In early 2026, the world is celebrating. Interest rates are finally trending down, and the stock market is hovering near all-time highs. But beneath this surface of prosperity, a silent predator has entered the room. We call it the stealth tax, while the Federal Reserve is busy fighting the last war against interest rates. A massive shift in global trade policy is about to trigger a second wave of inflation that will catch 90% of investors off guard. If you think your purchasing power is safe just because the 2024 crisis is over, you are missing the biggest economic pivot of the decade. For the first time since the 1940s, the average US tariff rate has surged past 11%. To put that in perspective, we are now living in a trade environment that your grandparents haven't seen since the end of World War II. These aren't just political headlines. They are direct costs added to every semiconductor, every car part, and every piece of raw steel entering the country. Businesses have spent 2025 trying to absorb these costs by eating into their profit margins. But in 2026, the grace period is over. The pre-tariff inventory has run dry. To understand where we are going, we have to look back at the wealth historian's favorite cautionary tale, the Smoot-Hawley Tariff Act of 1930. History tells us that tariffs are intended to protect domestic jobs. But in 1930, they did the opposite. They ignited a global trade war that collapsed international commerce by 65%. Today, our economy is much more fragile. In 1930, trade was only 16% of global output. Today, it is over 60%. The ripple effect of a 2026 trade war is not just a slowdown. It is a structural realignment of how wealth is distributed globally. Economists love to talk about core inflation, which conveniently ignores food and energy. But for the average person, in 2026, the hidden inflation is found in durables. Morningstar data now suggests that durable goods prices will rise by nearly 5% this year alone. Why? Because the supply chains for your phones, appliances, and laptops are deeply integrated with the very countries currently facing the highest trade barriers. When a component crosses 3 borders before reaching you, and each border adds a 10% tax, the math for the consumer becomes a nightmare. For the last 2 years, you could park your money in a high-yield savings account and earn a risk-free 5%. That era is officially dead. As interest rates fall in early 2026, those yields are sliding toward 3%. This creates a pincer movement on your wealth. Your savings are earning less, while the cost of living is rising due to tariffs. This is the moment where sitting on cash becomes a losing strategy. The 2026 wealth transfer will be driven by those who move out of cash and into inflation-resilient assets. Not all sectors are created equal in a trade war. The biggest sinking ships of 2026 are companies with high tariff pass-through, specifically the automotive and tech hardware industries. If a company builds in Mexico or China and sells in the US, their margins are being cannibalized. Keep a close eye on retail giants who rely on just-in-time global shipping. For these companies, the 2026 model is no longer about growth, it's about survival. So, where is the money going? The rising titans are companies that have successfully decoupled. Look for firms moving toward agentic AI and software-driven services. Why? Because you can't put a tariff on a cloud-based algorithm. While physical goods are being taxed at the border, the service economy remains largely untouched. Companies that provide engineering, data services, and AI infrastructure are the 2026 version of safe havens. In an era of trade volatility, real assets regain their crown. Gold has historically been the insurance policy for the global elite, and 2026 is no exception. But there is a new player in the room: tokenized real-world assets. We are seeing a massive trend where real estate, commodities, and even private credit are being moved onto the blockchain. This allows investors to bypass traditional banking friction and hedge against the fluctuating value of tariff-impacted fiat currencies. Watch hours are built on understanding the human element. The 2026 consumer is patience thin. After years of high prices, the public is no longer willing to wait it out. This leads to a divergence in spending, a luxury boom for the top 10% who are invested in the right assets, and a frugality crisis for everyone else. If you are a business owner or an investor, you must choose which side of this divide you are serving. There is no longer a middle ground in the 2026 economy. We cannot talk about 2026 without mentioning the retaliation factor. When the US raises tariffs, nations like China, Brazil, and the EU don't just sit still. They retaliate. We are already seeing strategic exemptions being used as political weapons. If you are invested in a company that relies on specialized Chinese minerals for EV batteries, you are at the mercy of a geopolitical chess game. In 2026, your portfolio is a political statement, whether you like it or not. So, how do you win? First, audit your portfolio for border exposure. If your holdings are 100% reliant on global hardware, it's time to diversify. Second, consider short-term treasury ETFs as a bridge, but look toward dividend growth stocks in domestic manufacturing. These companies benefit from the reindustrialization of the economy. Finally, keep 10% of your portfolio in liquid hedges, like gold or Bitcoin. The volatility of 2026 is a ladder, but only if you have the right shoes to climb it. History doesn't repeat itself, but it does rhyme. The hidden inflation of 2026 is the final test of the post-pandemic era. Those who rely on 20th century strategies will find themselves taxed into poverty. But those who understand the fusion of history, tech, and trade will see this as the greatest buying opportunity of their lives. The trade war isn't just about winning or losing. It's about who adapts the fastest. Don't be a victim of the stealth tax. Be the historian of your own wealth.